Welcome back to Talk Tickers. If you're tuning in, you're not here for the fluff pieces. You're here because you want to look under the hood.
You want the real mechanics of the market.
We are the professional earnings call summarization show for experienced investors. And today, we have a fascinating case study on the lift. We're dissecting MakeMyTrip's fiscal 2026 Q3 results.
And if you had this ticker, MMYT, on your watch list or in your portfolio, you probably needed a stiff drink when the market closed.
A stiff drink is putting it lightly. The vibe check was, it was essentially a crime scene. We have to talk about the market carnage.
Oh, yeah, you have to.
The stock closed down nearly 13%. We're talking a drop of almost $10 a share in one day.
It was brutal. And what makes this so perfect for us to dig into is the massive, massive disconnect between that reaction and the actual report.
Exactly. If you just saw the stock price, you'd think the business had just
imploded.
Yeah.
But you look at the filings and the company actually reported record adjusted profitability. They crossed a huge milestone.
It's the ultimate good news, bad tape scenario. You've got this underlying operational engine running hotter than ever, over $50 million in adjusted operating profit for the first time.
But
the flight deck ran into some serious regulatory turbulence in the accounting department. Well, things got very messy.
Messy is the right word. It's a classic collision. You've got operational muscle versus headline optics.
So our mission today is to parse that noise. Is that 13% drop a real warning sign? Or is it just, an algorithmic panic attack that creates an opportunity?
Let's start with the hard numbers. The results snapshot.
Okay, top line. Revenue came in at $295.7 million. That's up 10.6% year over year.
Which is solid, but there's nuance there. If you look at it in constant currency, so you strip out the FX noise from the rupee, that growth is actually more like 15.4%.
Okay, so it's strong double-digit growth, really.
Right. And the volume metrics, they back that up. Gross bookings hit $2.78 billion for the quarter.
That's an 11.8% increase. So almost $3 billion of travel flowed through their platform in just 3 months. The demand engine is definitely not broken.
No, people are clicking book. The consumers are there. But this is where we hit that friction point, the profit divergence. This is the part that gave investors whiplash.
Right. Okay, let's unpack this because it is stark. If you're a bull, you're looking at the non-GAAP numbers. Adjusted EPS hit 52 cents, up 33%.
Then, like you said, adjusted operating profit cleared that $50 million bar, came in at $50.7 million.
That's the cash is king view, the money the business actually generated.
Exactly, a very healthy margin profile. But
if you're a bear or just an automated trading bot, you saw the GAAP numbers.
And you panicked.
Reported profit just collapsed. It went from $27.1 million last year all the way down to just $7.3 million this quarter.
That's a 73% drop. Diluted EPS was just 7 cents. 7 cents versus 52 cents adjusted? That is a massive optical miss.
So we have to explain this gap. Why is it so huge? Is the money real?
It boils down to financial engineering costs, not an operational failure. They took a huge hit from net finance costs, about $27.7 million.
And this is tied to their zero coupon convertible notes. Let's pause there because that sounds like finance jargon bingo.
It does.
In plain English, these are bonds that don't pay regular cash interest, right?
Exactly. No cash is leaving the bank account each quarter. But under IFRS accounting rules, the company still has to record a kind of a theoretical interest expense on the P&L. It's called the accretion of discount.
So it's a phantom expense. The money didn't actually leave the building.
From a cash flow perspective, yes, it's a phantom. It hits the income statement, makes profit look terrible, but it doesn't touch the cash balance.
Which explains why their balance sheet is still a fortress. I'm looking at liquidity here. $830 million in cash and term deposits. That is a lot of dry powder.
And they are using it. They spent $41.5 million on share buybacks this very quarter. That's the ultimate tell.
Management is buying while the market is selling. They know those finance costs are just noise.
Right. But we can't let them off the hook completely. It wasn't just accounting. There were real operational headwinds.
Which brings us to our first deep dive segment, the air pocket.
This was the nasty surprise. You have to understand, Q3 is the golden quarter for Indian leisure travel. Festivals, holidays, wedding season. You expect planes to be full.
The baseline expectation was for, 5% growth in daily departures.
And instead, domestic daily departures actually grew by 5%.
Ah.
That is a 10-point swing from expectation to reality.
That's massive. So what happened? Did people just stop flying?
No, the demand was there. This was a supply shock. It was caused by a specific regulatory snag, the flight duty time limitation, or FDTL rules.
Ah, the pilot roster chaos we've been hearing about.
Exactly that. Regulators tightened the rules on how many hours pilots can fly, mandatory rest periods, and it hit the airlines like a ton of bricks. They just couldn't legally crew their scheduled flights.
So you've got peak season, demand is through the roof, and airlines are forced to ground planes because pilots need their mandated rest. It's a logistical nightmare.
It is. Management tried to spin it a bit. They claim they captured some spillover demand.
Meaning if you can't fly, maybe you book a bus or a cab on their platform instead.
Right. Since they own Redbus, they capture that shift. But let's be real.
Replacing a $150 flight with a $20 bus ticket isn't a one-for-one replacement.
Not even close. It hurts the top line. And the scary part for the market is the timeline. Management admitted this supply recovery is pushed to next fiscal year. They're talking April to June.
So that uncertainty is a big reason for the sell-off. But if the air segment was a supply shock, the hotel segment was more of a confusing math problem.
The hotel optical illusion.
Yes. I find this part fascinating. The government reduced the GST goods and services tax on hotel rooms under 7,500 rupees. They cut it from 12% down to 5%.
Which is a huge win for the consumer. A 7% price cut overnight. And it worked. We saw 23% growth in room nights in that segment.
23% volume growth is huge.
It is. But here's the illusion. Investors look at gross booking value, or GBV, the total dollar amount of the transaction.
Right. So if I book a room for $100 and the tax is 12, the GBV is 112. If the tax is suddenly only 5, the GBV is 105. The top line number looks lower.
Exactly. Management called it a math drag. GBV growth was 15.9%, which looks lukewarm next to that 23% volume explosion. It's artificially depressed by the tax cut.
So the business is actually healthier than the revenue number suggests. More customers, more transactions, but the total dollar value is suppressed.
And they warned this will persist for about 4 quarters until they lap the anniversary of the cut. So for the next year, the headline growth will look worse than the actual performance.
So let's recap the quarter so far. Phantom accounting costs tanking GAAP profit. Pilot rules grounding flights. And a tax cut making hotel revenue look smaller than it is.
It's like a perfect storm of noise.
But underneath that mess, there's a strategic offensive happening. We have to talk about AI.
Yes, let's pivot to the future. Let's talk about Myra, their AI chatbot.
Now, I'm usually skeptical when companies throw AI around on earnings calls. It often feels like buzzword bingo.
I get it, but the metrics here seemed pretty concrete. Myra is now handling over 50,000 daily conversations. That is serious scale.
Okay, 50,000 is a real number.
Yeah.
And they gave a quality score, right?
Yeah, 3.9 out of 5, with 72% of conversations rated as good. But what's really interesting isn't just saving money on call centers.
It's the strategic angle. They're using this as an acquisition tool for Tier 2 and Tier 3 cities.
That's the key insight. You have to understand the user in non-metro India. Typing out a complex query can be a high-friction activity.
So voice is the unlock.
Voice-led interactions on Myra are 50% higher in these regions. Someone in a smaller town is just picking up their phone and talking to Myra like they would a travel agent.
And 20% of these interactions are from completely new users. So it's not just servicing existing customers, it's expanding the market.
Precisely. But we have to play devil's advocate. The big scary question is the Google threat or the OpenAI threat. If I can ask ChatGPT to plan my trip, why do I need MakeMyTrip?
Management was defensive on this, but their argument made sense. They claim ownership of the fulfillment layer.
Right. A generic LLM can plan your trip. It can suggest a hotel. But can it actually book that specific bus seat? Can it verify that GST discount? Can it handle the payment and guarantee the refund?
It's the transaction plus trust versus just generic planning. They're betting that fulfillment is harder than planning.
It is, for now. That last mile of the transaction is where the value is captured.
Let's zoom out to the investor context before we get to trade ideas. The corporate restructuring. They got approval to merge Redbus India into MMT India.
This is significant housekeeping. It cleans up the corporate structure. And why do you clean up a structure?
To prepare for a capital event, you're thinking an eventual India IPO.
They didn't commit to a date, but if they ever want to list in India and get those Indian tech stock multiples, this merger was a necessary first step.
Okay, so looking at sentiment, the stock's down almost 27% in 3 months. The market is clearly skeptical.
The market hates noise, and this quarter was pure noise. Wall Street sees a revenue miss, they see air supply constraints, and they hit sell.
They're punishing the uncertainty. So the whole thesis now relies on two things.
One, do you believe the pilot issues are temporary? And two, do you believe the market will eventually look past the gap noise and value the company on its cash flow?
It's the P&L versus the cash flow statement. And right now, the P&L is losing the popularity contest.
Which brings us to the part of the show everyone waits for.
The trade ideas, where we take the data and try to find an edge.
But before we do, we have to say it.
This is not financial advice.
We are just two voices in your headphones analyzing data. Do your own work.
If you lose your shirt, don't blame us.
But if you buy a yacht, we do accept invitations.
Deal. I've got two ideas. The first one is based on that hotel illusion. I'm calling it the tax arb volume play.
Okay, walk me through it.
The pitch is simple. The algorithms are mispricing the GST cut. They see slowing gross booking value, they panic. But we see a 23% surge in volume for budget travelers. That volume is sticky.
So you're buying the volume explosion before the revenue numbers catch up.
Exactly. The trade is go long MMYT. But to hedge it, you pair it with a short on pure play luxury hotel REITs in the region.
Interesting. Why short luxury?
Because that tax cut only applies to rooms under 7,500 rupees. It's a massive funnel widener for the mass market. Luxury didn't get that benefit. So you're betting the volume growth in budget is real and sustainable, while luxury is stagnant.
I like it. It's an arbitrage on government policy. You're betting the math drag disappears in 4 quarters, revealing a huge new customer base.
Precisely. Now, what have you got?
Mine's a bit more about timing. I call it the summer schedule bounce.
Optimistic given the pilot chaos.
The pitch is this. That December air traffic dip was a roster error, not a demand collapse. The demand is coiled like a spring.
So how do you play it?
You buy slightly out of the money call options for June 2026.
June, that's very specific. Why?
It targets the report for the next fiscal quarter. Management guided to stabilization by April or May, when the summer schedule kicks in. The market has priced in a disaster. Those options are likely cheap right now.
So you're buying the dip on what you believe is a temporary bottleneck.
Correct. The moment the headlines change from pilot shortage to summer travel surge, those calls are going to print. You are betting on the airline fixing its HR department.
A bold bet on corporate efficiency.
It's a bet that money motivates solutions. Airlines don't like leaving money on the tarmac. They'll fix this.
I like that logic. Follow the incentives. All right, let's wrap this up.
This quarter was defined by that collision. Operating muscle versus headline noise.
Record adjusted profit of over $50 million against a 13% stock drop. All because of phantom finance costs and pilot schedules.
And don't forget the buybacks. Management spent $41.5 million buying their own stock. They're putting their money where their mouth is.
That's the final thought I want to leave everyone with. Management is aggressively buying their own stock while the market is aggressively selling it.
It's a high-stakes poker game. Management sees the internal data, the daily dashboards. The market just sees the JAP loss and the canceled flights.
So who was right about the recovery timeline? The people running the company or the people trading the ticker?
Usually the insiders know something, but in the short term, the tape is the only thing that matters.
A fascinating setup for Q4. We'll be watching closely to see if that summer schedule actually saves the day.
And if the market learns to read past the headline, stay curious.
That's it for this deep dive. Thanks for listening to Talk Tickers. We'll see you next time.